Okay, the stock market is going absolutely wild right now, and it seems like everyone is pointing the finger at the president. But what if there's more to it? What if this crash is actually part of a plan? Today, we're diving into a fascinating theory about what could really be going on behind the scenes.
I mean, you've seen it right. The headlines are a complete bloodbath. Social media is basically a five-alarm fire, and it feels like all fingers are pointing in one direction, accusing the president of deliberately torpedoing the market.
So, the big question on everyone's mind is, should you sell? Should you just get out now before it gets even worse? Well, that's the panic talking. Before you go and hit the big red eject button on your portfolio, let's just take a breath and figure out what's really going on here.
All right, first things first, let's talk about the panic that's gripping Wall Street. To figure out what you should do, we first have to understand what's causing all this anxiety in the first place. What's the real monster under the bed here?
This chaos isn't random. It's not just some streak of bad luck. We can actually trace all this volatility back to some very specific triggers. So let's break them down, starting with the two big ones that everybody's talking about.
Okay, so let's get into the conventional wisdom here. There are really two big reasons that everyone seems to agree on for why the market is so spooked right now and why we're seeing all this turbulence. All right, trigger number one, and this is the big one, the threat of a new trade war. The aggressive use of tariffs is sparking some serious fears. I'm talking about the possibility of rising prices for pretty much everything you buy, and even the risk of tipping the whole economy into a recession.
And look, we've actually seen something like this before, and it's a little chilling. Back in 1930, there was this thing called the Smoot-Hawley Tariff. It was supposed to protect American jobs, but instead it kicked off a global trade war that made the Great Depression so much worse. The fear is we're seeing a scary echo of that today.
And here's the thing you have to remember. When we talk about tariffs, they don't just hit some faceless foreign company. Ultimately, that cost gets passed straight on to you, the consumer. That means you end up paying more for everything from the car you drive to the food you put on your table. Okay, on to trigger number two. This one's all about geopolitical stability, or, right now, the lack of it. When long-standing alliances like NATO are put into question, it creates uncertainty and a potential power vacuum. And if there's one thing investors absolutely hate, it's instability. The market craves predictability, and that's in very short supply right now. All right, so those are the two conventional reasons you'll hear on the news. But now we get to the really juicy part. What if all of this isn't just a series of mistakes? What if it's all part of a plan? And look, I know this sounds like something out of a movie, but there's a pretty compelling theory out there that this whole market crash is intentional, that it's not an accident, but a calculated, super high-stakes power move. But man, a move like that is also playing with fire, with enormous risks if it backfires. So here's how the theory goes. The president can't just call up the Federal Reserve and tell them what to do. It's an independent body. But the Fed is responsible for keeping the economy stable. So if the stock market goes into a total free fall, it threatens the entire system. And that could force the Fed's hand. They might have no choice but to slash interest rates to stop a complete meltdown. But why? Why on earth would anyone do this? Why risk a market crash just to get lower interest rates? Well, it all comes down to one absolutely staggering number, the U.S. national debt. And managing the interest on that much debt is a huge, huge problem. Think about it like this. The U.S. national debt is like a massive, massive credit card bill. When interest rates are high, the country is paying a fortune every single year just in interest payments. But if you can force those rates down, all of a sudden, you're saving billions, maybe even trillions of dollars that can be used for other things. So, if this theory is correct, it completely flips the narrative. The crash isn't a mistake, it's a high-risk, high-reward gamble. It's like a controlled demolition designed to get a massive long-term win for the U.S. economy. Okay, so whether this is an accident or some kind of 4D chess move, the big question is, what should you be doing with your money right now? Because your strategy really should be the same either way. Let's talk about how to protect yourself and maybe even come out ahead. First things first, before you even think about buying a single stock, you need to get your own financial house in order. That means having a solid emergency fund with 3 to 6 months of living expenses saved up. And you've got to crush any high-interest debt, like credit cards. Think of this as your financial armor against any storm. Next, let's get some perspective, because it's easy to freak out. Market downturns feel like a disaster, but they're actually a normal part of the game. Look at this chart. Corrections, where the market drops 10 to 20%, happen all the time. Even bigger bear markets happen every few years. They're not a shocking surprise. They're a feature, not a bug.
And this right here is the key. The single biggest mistake investors make, time and time again, is panic selling. The truth is, a market downturn is basically a sale. Everything's marked down. The investors who stay calm, stay disciplined, and keep investing are the ones who build real wealth in the long run. So how do you stay disciplined when everyone else is running for the exits? One of the best tools is something called dollar cost averaging. It just means you invest the same amount of money on a regular schedule, like every month. It takes all the emotion out of it. You automatically buy more when prices are low and less when they're high. It's simple, steady, and it works.
And finally, step 3. You've heard it a million times, but it's so true. Don't put all your eggs in one basket. Spreading your money across different kinds of assets, stocks, bonds, maybe some real estate, gold, even a little crypto is how you protect yourself. If one part of your portfolio gets hammered, the others can help soften the blow. So, what's the ultimate takeaway here? It all comes down to your mindset. Look, every single market crash in history has eventually been followed by a recovery that reaches new highs. Seeing this moment as an opportunity to buy, not as a reason to panic, is what separates the successful investors from everyone else. So what are we looking at here? A terrifying crisis or the calculated beginning of a historic rebound? The truth is probably somewhere in between, but by understanding all the different angles, you can trade fear for strategy. Now you can see opportunity where everyone else just sees fear. The next move is yours.